Greetings, salutations, bonjour, however you say it in your neck of the woods. I'd like to welcome you to another episode of The Art of Reading Price Action. Again, I'd like to welcome you to another episode of The Art of Reading Price Action. If you don't know who I am, my name is Timothy Lee Rogers Sr., aka Aranya Grande, aka Big Spider. You hear me? And in this episode of The Art of Reading Price Action, we will be covering Fair Value Gaps Part 3. Yes, Part 3. Before we get started, a few people have been asking me how to join the mentorship. There is a join button somewhere on your screen. If you click on it, you just join the YouTube memberships and pick the tier that says mentorship. And then once you subscribe to that, or once you join that, make sure you go to the membership section and join the Discord. It's $24.99 a month. Like I say, all the videos will be on here absolutely free. What the mentorship gets you access to is me. Every Wednesday night, we cover homework. If there's homework in the videos, every second Sunday, we have a Q&A where we cover anything you want to talk about. And as a mentee, you also get access to the first and third Sunday Q&As that I do with the gold members and the Black Spider. So that's what you get for the $24.99 a month. Now, without further ado, let us get into the art of reading price action. Fair value gaps, part 3. Fair value gaps is part 3. Quick review. Fair value gaps are caused by one-sided price delivery, right? Buy-side delivery or sell-side delivery, right? Not liquidity, not buy-side liquidity, not sell-side liquidity. Buy-side delivery, meaning moving only up, and sell-side delivery, meaning moving only down during a certain period, right? That's what causes fair value gaps. Now, what is a fair value gap? A fair value gap is a 3-candle pattern where candles 1 and candle 3 do not share price. Candles 1 and candle 3 do not share price. So in this example, this is candle 1 and this is candle 3. And the space in between there where those wicks do not overlap, that is your fair value gap. The low of candle 1 in this instance and the high of candle 3 don't share price. That's your fair value gap. Now, like we discussed in part 2, fair value gaps tell you more than you realize. In part 2, we covered sentiment and continuations or reversals. Now, we're going to cover draw, how to let the fair value gaps help you, confirm or identify a draw on liquidity. And we're going to talk a little bit about how fair value gaps help you to decide how to mark out other PD arrays. Now, what you want to do with anything, not just fair value gaps, any of the ICT concepts, you want to start to see the clues in real time, right? And that's my job. I'm here to help you see the clues in real time. That's my job. Now, looking at this chart here, OG Gang, remember this. OG, if you are OG Gang member and you're a mentee, you remember this. This is how the chart looked way back in October when we had come down to some PD arrays. I only marked out the bullish order block because we haven't covered breakers. We haven't covered mitigation blocks. We covered the order blocks and swing highs, swing lows, and fair value gaps. So I only got the order block marked out here, but we had come down to a litany of monthly PD arrays, one being a bullish order block. And we were anticipating price to go back up. We said the monthly was in a bullish retracement, meaning it was still bullish, but in the short term, it was bearish and it was going to pull back down into these PD arrays. And we anticipated price to go back up off of that. This was our monthly anticipatory reactionary point. Now, what did price not do right here? Let's go back. as price came into the order block, right? Let's focus on the fair value gaps. We got a SIBI here, right? We got an expansion candle, right? Meaning we may not come directly back to this fair value gap. Then we went 1, 2 weeks before we returned. These are weekly candles, by the way, before we returned back into this fair value gap, right? And once we got back to the fair value gap, we came down and we created another SIBI here, right? As we moved into the monthly order block. So we had a SIBI, traded back to it, created another SIBI, traded into our monthly anticipatory reactionary point. And then what did price not do? What didn't price do here? Price did not create another fair value gap to the downside. The lack of creating a fair value gap can signal a slowing momentum or a reversal. As we come into our monthly fair value gap, we are anticipating a reversal, our anticipatory reactionary point. The lack of creating another SIBI or a bearish fair value gap, that is lending to our anticipation of a reversal. So price did not create a new SIBI. It's respecting the order block, but it did one other thing when it comes to fair value gaps. It introduced what we like to call an inversion fair value gap right here, right? The inversion fair value gap is when price closes on the opposite side of a fair value gap. On the opposite side of an FVG, right? That's what FVG stands for, fair value gap. On the opposite side of an FVG, right? Above a bearish fair value gap gives you an inversion fair value gap. If it closes below a bullish fair value gap, it gives you an inversion fair value gap. So if you're on the opposite side of what the fair value gap is designed to do, that creates an inversion fair value gap. Now, just like anything else, don't be looking for inversion fair value gaps everywhere. You want to look for the inversion fair value gaps at your anticipatory reactionary points. That's going to increase the probability of them doing their job, which is to support or resist price. Well, Tim, how does that help me with determining the draw? Now, if price does not, at this point, price is coming down, so the draw is to sell side delivery, right? Once we reach the sell side, we didn't continue to create fair value gaps. We rejected off of the sell side and created an inversion fair value gap. So on the weekly time frame, since we rejected the weekly sell side and created a inversion fair value gap, out on the weekly, our draw is now the high that sent you there. And on the monthly, since the monthly is respecting the PDub rate, the discount PDub rate as we anticipated it to, now the monthly draw is still to the buy side because the monthly draw never changed. The draw was the buy side. This was just a retracement into a discount PDub rate. So with the help of the fair value gaps, we were able to see as we were coming down, we were creating fair value gaps and created a SIBI, traded back to it, respected the SIBI, created the SIBI, traded back to it, respected the SIBI, got to the sell side, rejected it, and then created an inversion fair value gap. So now on the weekly, our draw is no longer to the sell side because we rejected this sell side. Our draw is now to the high that sent us there, which is buy side liquidity. So now it failed to create a bearish fair value gap, and it created an inversion fair value gap as stated. And then the monthly was always buy side liquidity because we were just anticipating a draw back into a discount PD array to find an opportunity to attack the buy side. Now, moving right along. When fair value gaps, this is another way to determine the draw. When fair value gaps create new fair value gaps, this is a signature of extreme bullishness or bearishness. Meaning, as we came back and created the inversion fair value gap, as you see here, we created a SIBI there. We created a BISI here, but then that BISI with this expansion candle, we're not anticipating price to come back directly into it. It created another BISI. So you got a BISI before even trading back into it. We created another BISI. So when fair value gaps create fair value gaps, that's exceedingly bullish. In this case, when BISIs create BISIs, that's exceedingly bullish. If SIBIs create SIBIs, that's exceedingly bearish. So this is exceedingly bullish. So we're continuing to look for a draw toward buy side liquidity. And you see we have monthly draws. This is a monthly high. This is a monthly high. Those are two different monthly highs that we talked about this in the past, right? And price was drawing up to it. As you see, it's giving us clues in real time. This BISI created this BISI without even trading back into it. Why? Because with the third candle as an expansion candle, you don't expect price to trade back to the fair value gap immediately. Not saying that it won't, but you don't anticipate it to do so. Now, what else do you notice about this area right up in here as we're creating these fair value gaps? I give you a couple seconds to give me an answer. Couple seconds up. Did you notice that we created another inversion fair value gap here? Well, how do we do that? Because this weekly candle closed above that SIBI's high right there. That's how and so we not only are creating, not only is BISIs creating BISIs, we've created another inversion fair value gap. So this is even more bullish, which lends to you being comfortable in your draw is correct, that you're watching for the right draw. Price is not going to just come back and reverse and take out the sell side. Even if it decides to pull back into the BISIs here, we're above a bullish fair value gap. So you would anticipate price to be supported by the fair value gaps. Now, let's touch on how fair value gaps can help you mark other PD arrays. I like to call this to wick or not to wick. Right? When do you use the wick of the PD array? If the wick overlaps a fair value gap, then I like to mark the wick as the place where I want to see the sensitivity of price when price trades back into it. I want to see it touch that wick and be like, oh, it's hot. I don't want to touch it no more. If the wick does not overlap with the fair value gap, then I will mark out the body. I would choose not to mark the wick, right? For example, here on this humongous or bearish order block right here, you see the wick is overlapping with this SIBI. So I would mark the wick there because I want to see extreme sensitivity when price decides to trade back up into that order block. If price decides to trade back up into that order block. Now, for this bearish breaker over here, there's no wick, right? So I just choose the body. If there was a wick and it was overlapping, then I would choose the wick if it overlapped. And if the wick came out, like for example, on this green candle, this up close candle here, how the wick is just outside of the fair value gap. If that wick was on this order, on this breaker, then I would mark the body in that case because the wick would not be overlapping with the fair value gap. And that's how the fair value gaps can help you determine how to mark the other PD arrays. And as we see, when price decides to trade back up is coming in, is showing extreme sensitivity to the areas that's wicks that's overlapping the fair value gap. And then price drop like it's hot. Now, that brings us to le homework. Guess what? There's no official homework this week. Now, that does not mean that you should not go and study what we've discussed this evening. Remember, set everything up like building blocks. Continue to study all of the concepts that we've been covering. Okay? Okay, now, that brings us to the end of another episode of The Art of Reading Price Action. Until the next time, I decided to get on Al Gore's internet and share my thoughts about this thing called price action. Remember, it's your boy, Aranya Grande, aka Big Spider. Y'all be safe out here in these trading streets, man. I'm gone. Yeah.